Good morning. This is Eric Jorgensen coming to you on the flip side. Today, as my guest, I have Matt Keefer with Gorfine Schiller Gardyn. He's a senior manager accountant, and we're going to answer 5 questions that I found very informative and helpful, and I trust most of you will as well. Matt, if you don't mind just giving us a quick overview of your background and your experience.
Sure. Yeah, I've been in the accounting field for about 15 years now. I work as a senior tax manager in Gorfine Schiller Gardyn. I do a lot of individuals, partnerships, corps, S corps, trusts, estate, pretty much a little bit of everything. A big part of my background is in the real estate practice, and then also high net worth individuals.
Awesome. So today the focus is going to be on individuals with disabilities and elderly. That's really what the flip side show is about, but that doesn't mean they can't own real estate or that they're not high net worth.
Right.
So I'm sure there's going to be some overlap. So I'm just going to jump right in. And the first question I have for you is, many of us are caring for an individual with a disability, or especially in the sandwich generation, we're caring for a parent, an elderly parent as well. Are there any tax breaks available for us that we may be overlooking or that we should be thinking about?
Yeah, there's definitely some stuff out there. The first thing you want to look at is probably the easiest thing is the dependency exemptions. Just because you have an elderly parent a lot of people just automatically assume dependent means it's a child, and that's not the case. A parent can be a dependent, relative can be a dependent, even someone that's not related to you can be a dependent. There's 2 basic tests to be a dependent. There's either you qualify as either what's called a qualifying child or what's called a qualifying relative. I'll give you a quick rundown. I have those tests printed in front of me because the tax code's pretty voluminous and it's hard to memorize everything. So, but the qualifying child, there's 5 tests here. The first test is what's called the relationship test. So you got to be the taxpayer's son, daughter, stepson, stepdaughter, brother, sister, stepbrother, stepsister, or a descendant of any of those. So a grandchild would also work. And then the next test is the residency test. So the person would need to live in the same principal residence as the taxpayer for more than half of the tax year. And with that test, temporary absences are excused. So if you have a child that's going away to college, that would not be considered not living with the parent. They would still be considered living with the parent. And then the next test is your age test. With that one, it's the child needs to be under the age of 19 or a full-time student under the age of 24. And then there's also an exception if you have someone that's permanently and totally disabled. And then the next step is the support test. With that, you need to be providing more than 1/2 of their support. And generally supports basically the living expenses. So the food, shelter, education, and even entertainment costs can be factored into that. So you want to basically look at what's the total support for that person and then compare how much of the support was provided by you and how much was provided by the dependent. And as long as that's over that 50% threshold, then you pass that test. And then the last test is something that's probably fairly unusual, but it's if you have a married child, that child cannot file a joint return to be able to claim them as a dependent, unless they're just filing to claim a refund. And then, so that's the qualifying child test. And then the other way to get a dependency exemption is what's called the qualifying relative test. And with that one, it either has to be a specified relative, which is parent, child, brother, sister, kind of similar to the same relationships as the qualifying child. But you can also have an unrelated individual that you could potentially claim as a dependent. With that, they would actually need to live with you in the same principal residence, whereas the specified relative does not necessarily need to live with you. So you can have your parent that lives in a different location, but they would still qualify under this test. The next step in determining whether you're a qualified relative is there's a gross income test. So that person you're looking at needs to have gross income that's less than the exemption amount for the tax year. For 2016, that was $4,050. Now there's some exceptions to this gross income test. Non-taxable income is not factored into the gross income test. So with elderly individuals, if you have Social Security income, a portion of that's going to be tax exempt. So that income would not be factored into the gross income. And additionally, with children, scholarships, certain scholarships are not factored into that gross income test. And then the next test you have is also, again, the support test. You still have to provide more than one half of their support. In relation to the income test, that non-taxable income that was excluded from the gross income, you do have to factor that into the support test. So if they're using that non-taxable income to support themselves, then you have to factor that in. So if you have an elderly person where you're providing, say total support's 30,000 and they're providing about 16,000 of that with their non-taxable income, they're not going to pass the support test. And then the last test is just they're not a qualifying child of the taxpayer. So they wouldn't be a qualifying relative, but they would be a qualifying child. So you would get the dependency exemption kind of either way.
Awesome. And I'm not going to expect the viewers to remember all 5 tests, but I want to touch on a couple of them that resonated with me as a parent. So the first one, as a qualifying child, I think it's safe to say if your child is collecting SSI and that's their only stream of income because they're disabled,
right,
or they have disabilities and they can't work, odds are that $733 or $783 a month that you're getting is not going to be enough to pay one half of rent,
right,
where you live, and food and everything else. Right. So I would feel that it's a pretty safe bet that they're gonna, if you have a child with a disability living with you, even over the age of 19 or 24,
right,
they're gonna probably meet that requirement.
Yeah, and that's probably true. And
then the next piece is with a qualifying relative. A lot of veterans I work with are getting some form of VA disability, which is tax-free.
Right.
And it's not necessarily substantial. You know, if you're receiving 20 or 30%, you may be getting $200 or $300 a month, which is enough to help keep you afloat if you have Social Security. But to your point, it may not be enough to make sure you're paying 50%. And I'm thinking, I live in Montgomery County. $30,000 in Montgomery County is not going to get you very far.
No.
So I think a lot of it's going to depend on where you live. I believe you said you live out in Westminster, so I think your cost of living is much lower out there.
Right, it is.
So that's the other thing to be cognizant about, right? Is where are you living? What are your costs of living?
Yep.
You're thinking about. Awesome. So if somebody has further questions about this, I'm going to make sure they have your information linked so they can follow up with you via email or go to your website.
Certainly.
Touch base with you.
Yeah, it's not a cut and dry answer either, because these are the general tests. I mean, there's always, with the Internal Revenue Code, there's always exceptions to the general rules. So it's an area where you got to look at all the different facts.
Right, and in my opinion, what I've found very, very helpful for me is to have somebody like you ask me questions to draw some more information out of me, because I may be looking at something and it's just, okay, this is my frame of reference. This is how I think it is. Yep. But having an accountant ask me a question, it could reframe it for me and say, oh, well, no, I didn't think of that, blah, blah, blah.
Right. And typically when we prepare tax returns, we like to provide the taxpayers with, it's called an organizer that gives them some guideline questions to help us with asking them additional questions to pull some of these answers out that helps and benefits with some additional deductions.
And I think what the viewers are going to find as we go through these questions, it's really important to be forthcoming with the accountant. It's not, it shouldn't be adversarial. You shouldn't feel threatened. If you feel like that, you're probably working with, well, there's no problem. You are working with the wrong person. Right.
No, that's true. It's definitely communication's important. We have to know maybe a little more personal information than the taxpayer wants to give to us, but if they want to get the best benefit for deductions, we need to know some of this information.
Exactly. And so we covered the, qualifying relative, qualifying child.
Right.
And yesterday you and I were discussing medical expenses and how challenging it can be. Can you go over that again, just a little bit more about the medical expense? What are some things people may be overlooking, or maybe they're taking and they shouldn't be taking?
Sure. I think in relation to what we were just talking about, one of the medical expense areas that people may be overlooking is if you're paying expenses for a parent and they don't qualify as a qualifying relative, and it's specifically because of that gross income test, there's actually an exception for the medical expense rules that you can still claim those medical expenses even though they don't qualify as a dependent solely because of that gross income test. So if you have an elderly parent that you're taking care of and say they're getting IRA distributions that are throwing them over that threshold, and you're expending significant amounts of money if it's someone that's in home nursing care or nursing home for dementia or something, they can't handle their bodily functions, then in that case, I mean, you could see substantial medical expenses, and those could be deductible to you, even though you're not claiming that person as a dependent.
Another example I was thinking of is, even if they're not necessarily being taken care of in a nursing home, but if you're driving them to and from dialysis,
right?
Because dialysis can be pretty expensive, especially if it's not covered by insurance. But isn't there something about mileage as well, or?
Yes, there's medical mileage. There's a dollar amount that's thrown out by the IRS every year. It's modified based on cost of living every year. I think it's maybe about 25 cents per mile, around about that.
So it may not be very helpful for the one-off, you just have that one appointment.
Right.
If heaven forbid you're driving somewhere for specialist care like cancer treatments or dialysis or any of those specialties where you have to go to a whole other city or state, it's important to keep track of those expenses. I mean, because that adds up, I would think, if you're doing it every month or even every other month.
Yes, it does. And also if you have to pay money to park at the lot, that you also want to keep track of that.
And what about if you have to get a hotel room or something?
That depends. It would have to be specific travel in relation to the medical end.
So that's another one where it's going to be case by case, talk to a professional.
Yeah, definitely. I mean, you want to definitely look at the fact pattern there. But some other medical things that maybe people don't think about is medical equipment that's specific to a disability, maybe some type of improvement to the house that you have to do, maybe
like a ramp?
Like a ramp. Now, that it's not the total cost of what you added to the house. You have to look at the cost versus the increase in value you've had to your house, and then the difference is what you get to deduct. What else? Some other things is specially prepared food. Like if you have a physician that recommends a special diet, that would potentially be deductible.
Now, that's not the same thing as somebody deciding themselves, I'm going to be gluten-free, or I'm going to...
Right. Yeah, I mean, most of the medical costs, it has to be physician recommended or required to be able to take the majority of these types of things.
Okay.
Like another example is that if someone goes out and buys a pair of shoes based on medical recommendations, that would be another type of thing that could be deductible.
And that could get expensive if they're being tailor-made, things of that nature.
Right.
Awesome. So those are deductions, right?
Right, correct.
So can you kind of go into what a deduction is versus what a credit is?
Sure. Well, the deduction reduces your taxable income base, so the amount that you're calculating your tax on, whereas a credit reduces the direct amount of tax. So if a deduction is only worth the amount of your marginal tax bracket, so if, say you're in the 25% tax bracket, every dollar of deduction is only going to save you 25 cents of tax. But a credit, every dollar of a credit will save you $1 of tax.
So credits are a little more favorable, but I imagine they're harder to come by.
They're definitely harder to come by. There's not as many, and they're pretty specific. I mean, the most common that you have is your child tax credit. There's dependent care credits. There's the foreign income credit, and that's kind of if you have some dividend income that maybe is a company based in a foreign nation, and they have to pay some tax on that dividend. That's kind of the most common area of that. There's some adoption credits, and did I mention earned income credit?
Mm-hmm.
And then some of the residential energy credits are pretty common too. And the thing is, most of the personal credits aren't as substantial as some of the business credits that are out there. The adoption credit is one of the larger ones, but if you're getting into the adoption area, you're probably spending a large sum of money to go through that process. So it might not be as valuable as it might seem.
And then for deductions, obviously, I think the biggest one most people are familiar with is that deduction they get for owning their house, that interest deduction.
Yep.
But the longer you own the house, the smaller that becomes diminishing gains, right?
Right. Yes. Yeah. I mean, you get the interest and then also the property taxes. And there's also other types of deductions you could potentially get if you have to pay points when you purchase the home, or if you refinance a home, you get to take the points. But in the case of refinance, you actually have to take that over the period of the life of the loan.
So if you refinance for 30 years, you're going to be deducting it over the next 30 years.
Correct. Right.
And then, so I'm a renter. I'm a diehard renter. I'm just too lazy to own a house and do all the work that's required.
Okay.
So I'm obviously missing out on that deduction.
Right.
But some of the other deductions I'm familiar with are like your charitable, and as we mentioned earlier, your medical expenses.
Mm-hmm.
And then there's, I spend some money for some things I do for work. I know teachers do the same thing. Can you talk a little bit more about those deductions, and then just how they can help? And because I know there's a standard deduction too, right? So how do you know what you're supposed to use?
Well, I mean, the general rule is whichever amount produces the higher deduction is generally going to be the better case. The standard deduction, it's a standard amount based on your age. You get a little bit extra once you're over the age of 65. With the itemized, like we said, you start with the medical expenses. Now, those are only deductible in excess of 10% of your adjusted gross income. So a lot of times it's not very helpful to most taxpayers, because you'd have to have substantial medical expenses to really get over that threshold and get to an amount that's even beneficial for you.
Right. I see that more with the elderly clients. As they get older, their prescriptions get more expensive. They start needing additional care. But
Right.
People our age, it doesn't very, very rarely do, unless you have a child or yourself, you have significant disabilities and you're paying for therapies. But
yeah. Correct. And then the next area of itemized deductions, you have your state and local taxes. That could be your state income taxes. If you live in a state where there is not state income tax, there's also what's called a sales tax. And that can be based on the actual amount of sales tax you paid, or there's actually a kind of like a safe harbor that they have that's available. And that's usually the easier way to go about it, because it's obviously very difficult to keep track of all your big ticket sales. I mean, generally it's going to be, in the case you have big ticket, if you purchased a car or maybe an RV or boat, something along that lines, but pretty much the main reasons you'd see the actual sales tax. And then once you get past the state and local taxes, you have your real estate taxes, then your charitable contributions, but you have cash contributions that you might make, and then also non-cash. So if you're donating anything to Salvation Army or Goodwill along that lines, you want to keep track of that. And generally with that, you want to kind of utilize Goodwill and Salvation Army, kind of have guidelines out there that could give you some guidance on what value to use for property that you're donating. I recommend that you try to find that information, because you don't want to just throw a deduction on your return without really having some support to what you've claimed.
And then the miscellaneous expenses. For example, if I'm paying for a seminar, or I'm a member of a couple organizations, and I believe my accountant has had me take those as deductions and membership fees as well.
Right. Yeah, those are the next area. It's what's called miscellaneous itemized deductions, and those have to exceed 2% of your adjusted gross income. So kind of similar to the medical, but a lesser threshold. So again, that's kind of an area where a lot of times we have those expenses, but it doesn't get past that threshold, and it might not be even deductible to you. But there's employee business expenses that could potentially be deducted, but those can only be deducted if the employer doesn't have a reimbursement plan in place. So if you have an employer that is reimbursing you for those expenses, or has the ability to reimburse you for those expenses, you can't then go deduct those in addition to what you got reimbursed for, or
no double dipping.
Could get reimbursed for. And then there's also the tax preparation fees. So whatever you would pay me to prepare your return or give you advice in relation to your tax return, that's deductible as a 2% deduction. And then in relation to you, your investment advice fees, those are also deductible.
So, I mean, in theory, if an individual has a multitude of things, let's say they're caring for an elderly parent, they're helping, and who doesn't meet the qualifying relative, but they're still paying for all the medications.
Right.
So they meet that threshold, right? So, let's say they meet that threshold, they meet their miscellaneous expenses threshold, they add it up, and now you're comparing it to whatever the standard deduction is to say, okay, I'm getting more from here than I am from here?
That's correct, yes.
Seems like a lot of work.
Well, nowadays with the tax software, that component of it's pretty much automatically handled. The software typically is going to look at that automatically and decide what's going to be a better case. I mean, we obviously as tax professionals take a second look at that to make sure. We can't always trust the software, but it's generally not as difficult as it might seem.
Well, and going back to what we were discussing earlier about why you would want to work with a professional, for me, it's peace of mind knowing that I want to deduct this. Yes, it's legitimate because I have a second person looking at it saying, okay, Eric, you're stretching the line here. If you get audited, it's probably not going to fly. Or no, that's clearly a deduction. Go ahead and add it. Just keeping me honest.
Mm-hmm. Yeah, no, I agree. I mean, once you get to the point where you're beyond just maybe having a W-2 and the standard deduction, and you're starting to basically take a position on the tax return of claiming a deduction that may or may not be deductible, then that's an area where you have to feel comfortable if you're preparing your own return that if you get audited, that you're going to be able to back that up and support it and make sure it's actually deductible under the Internal Revenue Code. So yeah, I agree. Once you start crossing that line, it's maybe time to start reaching out to a professional to at least have some reliance.
And I have a couple other litmus tests or benchmarks I use when I'm working with my clients to say, I really think you should work with an accountant. And you can tell me if I'm off base, but so some of the things I'm looking at are, if you are a sandwich generation, so maybe you have your mom or dad or in-laws living with you, I'm going to want you to talk to an accountant, because now we're getting too far in the weeds to figure out how much support are you providing versus what's their income. Well, they have Social Security, but they don't have a pension or whatever.
Right.
That's a lot unless that's just what you do for a living, to try to take into account and ask the right questions.
No, I agree. I mean, because there's even situations where I actually had a situation where instead of picking up the medical costs on the parent's I'm sorry, on the kids' returns for the parents, I was actually able to do the reverse instead, where the kids paid the costs for the parent, but there's a court case out there, and it's not going to work necessarily for every taxpayer, but there's a court case out there that lets you treat those costs that the kids paid for the parent as though the parent paid those costs. It's treated as it was a gift to the parent. So in her case, it was not beneficial to the kids because their adjusted gross income was way too high to even get close to being able to use those medical costs. But with the parent, her gross income was at the level where the medical costs were so substantial that it pretty much wiped out her entire taxable income. So that's just the type of situation that if you're preparing your own return, you're not necessarily going to know that and think of that.
So I think a good rule of thumb is, and I believe we've already said this, but I'm going to reiterate it. If you're just not doing a 1040 easy, or you're coming into stuff where you're like, I don't know if I should count this or not, spend the extra money, get an accountant, because down the road, in my opinion, it's going to save you so much more. It's just going to save you time, energy, and future expense.
Yeah, I would agree with that. And especially if you start getting into the areas where you have a business or some rental properties, because there's much more opportunities to reduce your taxes with deductions or credits. So it's definitely an area where you don't really want to do it on your own unless you just don't have, maybe you have a rental property that's bringing in income and your only expenses are some property taxes and mortgage interest. But when you start getting beyond that, then yeah, I would say it's time to start looking out for an accountant.
Yeah, and I mean, speaking as a financial planner, because I'll have people come in and tell me they want help reducing their taxable, they're reducing their taxable impact. I can help you to the extent of, are you contributing enough to your retirement account? Do you have the right type of retirement account if you're a business owner? That type of thing. But at the end of the day, I'm going to want to partner with an accountant. And if you're already working with an accountant, in a lot of ways it's easier because you have that relationship.
Right.
And then I just, and much like you work with me, we would just work together and then go to the client as a unified saying, this is what we're doing, and the client doesn't have to think about it.
Right. Yeah, and I agree with that. We try our best to work directly with the investment advisors so that we're all on the together and making decisions. That we don't want to be the accountant deciding let's sell a bunch of stock and the investment advisor had no idea that that decision was made, or on the other side of the spectrum you make a decision that just doesn't make tax sense. So you got to be a collective group and make sure that you're making the best decisions.
So that covers everything I wanted to talk about today. Was there anything that you feel like I should have asked and didn't, or any last little bit? Could you just give us the best way to reach you?
Yeah, I mean, the best way to reach me is probably through my email, which is listed on our website. I think my phone number is also on there. I'm glad to take any questions. Shoot me an email, give me a call. As far as anything we didn't touch on, take a quick peek at what we looked at. I guess a couple of things on the medical. We didn't really look at maybe some items that people are taking that they really shouldn't be. A lot of times you're going to get reimbursed by insurance for costs. You got to make sure you're not deducting those costs. It's
like
not
glasses, hearing aids. That's where I typically see it, is branded glasses or hearing aids or something.
Right. And then over-the-counter medicines, those aren't deductible. It has to be physician recommended or required or prescribed. So those are just some passing thoughts. But other than that, I think I didn't have anything else to add.
Awesome. Well, thank you, Matt, for taking the time today. I'm going to post a link to your website when I post the video. And I'm also going to post the topics we discussed. And you were kind enough to give me a handout that I'm going to make sure we link up as well for some common medical ones that are much too, I mean, it's almost it's a full page if I remember correctly. Much more than we have time for to go in line by line.
Right. And in relation to that, there's actually on the IRS website a assistant that you can go in and it will guide you as to whether medical expense is deductible or not. I've not personally used it, so I can't vouch for it, but it's another tool that's out there.
Awesome. Well, thank you again for your time. And to the audience, I hope you find this as useful as I did. Take care.
Great. Thanks. You too.